So today's talk, this presentation, which I'll try to be as quick as possible, and after that we've got three speakers after that, which would be Integra Gold, George Salamis, Northern Shield, Ian Bliss, and an extra one, Mario Stefano from Cordoba Minerals. So we've got four talks in all, including mine. So we'll try to whip through this, and then we have a panel after that, and then straight on to the alcohol. That's right, yes. Okay, so this talk is about growth, because I've got another talk that I'm doing later this year about growth with the American Exploration and Mining Association, and they're all about growth. And then what I've been hearing, which is good, from the Denver Gold Show and the actions that we've seen, is that, maybe the gold mining companies especially have turned a leaf with respect to not looking for growth's sake, rather than looking at growth in margin, growth in profitability, which is anathema to most gold companies. So that change is what I wanted to show, and then look at how you manage that change as an investor potentially in the junior mining sector. So Gary Goldberg, Newmont CEO, he wasn't the CEO when I was there, but he basically said that, give me my glasses here, in the heydays, which actually was when I was there, we're pushing for volume rather than value, looking for any additional cost, an ounce for any additional cost. And when I went there, I left a copper company, Phelps Dodge, and moved to work for Newmont. And at Phelps Dodge, when you got up the elevator, right before you went up the elevator, the two things they would always talk about is cost and safety. Ram it into your head. And when I got to Newmont, it was all about ounces. And guidance for ounces was the most important thing. You could screw around with capital, screw around with cost, but don't get the ounces wrong. And so when we had Yanacocha going, there was always ounces at Yanacocha, which would be lower cost than most of our portfolio, so we would actually get a win. But then as Yanacocha could not pick up the slack, we were adding really low margin incremental MPV ounces from Nevada. And that always made our return look worse and our costs go up. And that was the period we were at. So now, it's not management driven, it's basically investor driven. So now the emphasis is on margin versus production growth. That could change, but right now that's the emphasis. And you could see if you read through all the presentations or watched them through the Gold Show, that's what these companies are citing. It's cost control, it's reductions in capital, it's exploration cuts, just to alleviate all the impairments that they've taken and improve their balance sheets because of the debt profiles that some of them still hold. So Barrick, Newmont, and Gold Corp have no issues with flat production profiles anymore. So it used to be 3 to 5% compound annual growth rates over 5 years. Then it was 2 to 3%. Now it's 0, and some negative. So what Barrick's done is, because of their debt, because of their high cost of their marginal ounces, they basically focused on the core assets where they have relevant experience. They've got comparative advantage, so they focused in on the Americas and specifically Nevada. So 75 to 80% of their production comes from their core, and their core works at 10-20. Everything else doesn't really matter. So that's why you see a lot of these big companies pitching assets. So you see a lot of other companies, junior companies, raising money to buy those assets. And why would a major sell production when I worked for corporate development, Newmont, the last thing we would ever do is sell production? Now we have no problem doing that. Why? Because this stuff is high cost, it doesn't move the needle, and also it's probably near the end of the mine life for us in terms of a big company, but a little company could lower the throughput and maybe make it go for 10 years. The other advantage that they probably don't talk about is the liability. There's nothing I'd like better is to pitch that liability and get off my balance sheet as well. So this is, technically a win-win for the big company. Getting rid of an asset that doesn't move my needle, getting rid of something that's a high cost, and getting rid of the liability. And there's companies looking for these kinds of assets, and in this environment, being able to raise money to actually buy them. And so now they're talking about hurdle rates, which they never talked about. That now I want a 15% internal rate of return from every one of my projects, but I want it at my reserve price, which is now $1,200 gold. There's not too many, and I'll show you from the depletion of the reserves of their ounces that work. So they've got to take cuts to the reserves. So this is from a friend of mine who's now the chief economist for Newmont. We worked together when I was there, and I borrowed and stole some of his slides, but I let him know that I was doing this. But right now, we are forecasting right now a 1% compound annual growth rate in production declines, not unlike what we saw in the 2000s. And granted, we could say that, and a big company would want to say that, because they want to show that, hey, I'm not growing, but hey, look, nobody else is growing either. But then when you look at it and break it down, Gold Corp did this slide about all the reserves for these major companies, and basically they've dropped 15% in a couple of years. So that's telling. If you don't have a reserve base, you've got nothing to grow on. Right now, you're just replacing ounces. You're running to stand still. So let's break down one of these big companies and see what's actually happening. So Newmont had a drop of 8.5 million ounces in the end of 2015 year on year. And when I worked for Newmont, there was an oil guy that was running it, and he was all about repletion of reserves. That's all he talked about, repletion of reserves. If you use them, get them back. And so now we're showing that we can't replete these reserves, especially a company that's got a reserve base of about 80 million ounces. And so if you look at it, the entire drop was more like 17.5 million ounces. So you had 6.5 from depletion, just from production. You've got 3 million ounces, and I'll show you this on the sensitivity, from the production drop, from taking it down to 1,200. And then the other thing is when you do these big projects that have big footprints and you end up with a social license to operate issue like Conga, that's 6.5 million ounces you just dropped. That's part of the 7.2. So again, 17.5 million ounces, how do you offset that? You do brownfields exploration, which I'll show you that's what they're doing now. They're not doing greenfield exploration, they're doing brownfield. That's a low risk win for them. So they added 5 million ounces from there. But then they had to acquire, and they added 4 million ounces by buying a producer, the Cripple Creek asset from Anglo. Okay, let's look at one more. So in terms of Gold Corp, they actually repleted their reserves, and technically they look like they're up 1.6 million ounces. But they've had to offset about 2.7 million ounces of a drop on production. But interestingly with Gold Corp, they actually raised their gold price. They didn't lower it. They were already at about 1,100, 1,000, and then they moved it up 200. So just a movement in $200 an ounce only gave them 1 million ounces. So they got that. But they really needed to acquire an asset to show that they were actually above and repleting reserves. And so they ended up getting coffee, and that added 2.2 million ounces of reserves to their balance sheet. So here's the issue. It's not marginal ounces. I don't need marginal ounces. If I change the gold price $200 an ounce, I can add 11 million ounces without acquiring them. I know where they are, and I've already booked them in reserves before. So it's not challenging for me. So what have we seen? So because we're asking for, we've had debt issues. A lot of my reserves are really high cost and don't make any sense. They don't work at 1,200. I don't have the money to spend. I don't care about production growth anymore. So we see a steep drop in development capital. So we've gone from $10 billion in about 2012 at the height down to $2 billion. And some of that capital is due to capital escalation that everybody wanted to build at the same time, but some of it just scope change. I don't have that many projects to build. I mean, sustaining capital dropped, but nowhere near as much as development capital. And then we see the drop in exploration expenditures. Whatever they're spending, they tend to spend more on brownfield than greenfield. Basically, Gold Corp said that they've cut their greenfield. 80% of Newmont's $200 million, which isn't a bad number, is spent on brownfields. We would argue that the only way to find the quality deposits is really greenfield. So what have we seen? How is this translated into what's going on in the market? We've seen acquisitions of low-risk production in low geopolitical risk jurisdictions. We saw Tahoe take Lakeshore. We saw Silver Standard do Claude. And then we were seeing development plays getting acquired like Gold Corp's Kaminak, Nevson Reservoir. Lately, we've seen more production, but this one might be debatable to see how November 23rd that vote goes. Now we see that Goldfields and potentially Silver Standard are looking to, had made an offer for Kirkland, but right now that combination is Kirkland and Newmarket. Another one we saw this last week was Goldfields again, come in for 50% of an open pit gold project in Western Australia. So what you'll see is a lot of district scale opportunity with some of these. You'll see low geopolitical risk, and some of them you'll see low risk with respect to production. They want to add these ounces, but they don't want to do a lot to add them. And Agnico's model in terms of M&A was always buy something that you could grow. So they looked like they paid a lot on a per ounce basis to acquire the asset, but then they knew or hoped that they could add to it. And so they would acquire it from anywhere $43 to about $190 an ounce. But then they would add discovery ounces over and above of what they thought they had at $16 to $50 an ounce. So growing an asset post-acquisition was important, and it's easier to do that with a district scale play. So could that be what Gold Corp thought of coffee? I mean, David Garofalo's ex-Agnico. Kaminak's got a reserve, or had a reserve at coffee at about 2.1 million ounces. He's thinking that that thing could be 3 to 5 times bigger. That's why he acquired it. So we talked about quality, but then what's the issue with geopolitical risk? Is it all that important? And what Agnico would tell you, it is. They'd say, hey, look at me, I'm on the left-hand side, I don't have very many risky assets, I'm in Canada, I'm in Scandinavia, I'm in all these places that aren't risky. But then we look at Centerra on the other side, Kyrgyzstan, Kumtor. What are they trying to do? They're trying to acquire assets like get into hard rock in northern Ontario. They're looking at the acquisition of Thompson Creek for the deposit in British Columbia. They're looking to do joint ventures in Mexico. They're really trying to diversify their geopolitical risk. And Eldorado's in a similar position because a lot of their assets are in Greece and Turkey and also in Romania. But what's absent here is the Randgolds, the African producers from this chart, because theoretically most of them have a lot of geopolitical risk. But this slide says that as important as geopolitical risk is to some investors, they will pay for fiscal discipline. And Randgold has been one of the most ardent companies about fiscal discipline and including reserves at low gold prices, having an idea of what kind of open pit grades they thought made sense for them, and really having hurdle rates that they've invoked for the last decade. And so that, despite the fact that they've got assets in geopolitically risky jurisdictions like the DRC and Mali and all of Africa, that they still traded a premium to a company that's got about, only 20% in high geopolitical risk areas, like Agnico. Yeah. So how has the market adjusted over the last, let's say, 10, 11 months? So what I noticed from Precious Metal Summit, all the bankers are back. The brokerage firms are back, the sell-side analysts are back, the sales teams are back. And so I'd never seen such a consolidated group effort over the past 5 years as I saw this last time. It was a real team effort in terms of the brokerage firms to, I don't want to say attack, but confront, help the companies that hadn't seen nor heard from these people in the last 3 years. But a lot of this was driven by quality. They're looking for quality exploration projects, and so the corporate development teams as well were well representative. I saw a decent-sized team for Gold Corp, a huge team from Agnico. Newmont's always well represented, Kinross, all of them were there. So a lot more companies are worried now that they don't have quality assets. Now they're looking for them. The M&A potentially that we've shown you will be weighed against fiscal discipline. So they're not going to break the piggy bank here going forward, especially if they're asking for hurdle rates of 15% at gold prices of $1,200. And what we've seen over this period, obviously, even despite this last week, junior miners still outperforming the gold price and underperforming. High beta, almost 5 times. So, and I'll also break through some of the financing we've seen year to date and who's getting funded. This will be quick because I got 4 minutes. So, speed dating at the Precious Metal Summit. So you saw a 60% increase in investors from the buy side go to that. 36% from the corporate side going. And some juniors that I talked to with, I mean, they were basically faded out after about 10 cups of coffee, about 18 meetings in a row in one day. And when they meet one of these corporate development teams, they might meet 8 people at the same time. So in terms of footprints in junior companies, what we've seen is a lot of them coming up. You know, Kinross, I mean, M&A strategy is they first look at the asset, whether the acquisition's transactable, then if it's accretive, and then they look at jurisdictions. Some might put jurisdictions first. So Kinross has now got JVs in BC, Yukon, Northwest Territories. You can read them off, but all of them are doing joint ventures. Why? Because they've cut grassroots and they don't have access to these district scale land packages now anymore because they've cut a lot of them out. And so in the first quarter, what we were seeing was typical of what we see most years. We see the big financings. We see the cash flowing precious metals companies. We see the streamers. We see all these guys getting financed first. And so we had almost $4 billion of financings over $50 million in the first, probably most of it was in the first quarter. And then in the $10 to $50 million range, we saw about $900 million of financing. But now, if you look, here we're talking about cash flow producers, we're talking about royalty companies, we're talking about lower risk companies. But now, as we move forward, we're seeing gold developers, gold explorers, silver explorers and developers. So now we're moving upstream with respect to the companies in higher risk, and people are willing to take a punt on these guys. The financings aren't as much, but they're looking for a high return, granted with a high risk asset. And then when we get to the really low, less than 10 million, which I guess now is not that low, gold explorers, gold developers, these kind of companies dominate. That's where a lot of the money's going. And so like I said, junior miners are providing the leverage. So even up to date right now, we're still looking at gold is up about 15%. The GDXJ, if you use that as a proxy, is up 80%. I mean, at one time it was up 150 plus. So in summary, which is good because I got 50 seconds. So profitability over volume, if that's the new thesis. The issue is reserves are depleting faster than these guys can replace them. But is that important? The question is, can they replace these quality assets? That's what I think is more the issue, because they can replace marginal ounces. I think no matter what, production's set to decline. The drop in CapEx and the balance sheets, more fiscal discipline is still going to be an issue going forward because, again, a lot of these guys still haven't got through their issues with debt. That drop in exploration, low-risk brownfield is still favored over greenfield, and as we know that you need to have a decent greenfield budgeted program for over 5 years to generate this pipeline of quality assets, which these guys do not have. So hence we have the growing interest in junior explorers. So if you're going to look at these junior explorers, I would say you want to see it from the point of view of the acquirer or the person that's doing the joint venture. They would like to grow the ounces post-acquisition, so a district scale play would be a better thing than somebody who's got a postage stamp. Mining-friendly jurisdictions, and I say friendly and not low geopolitical risk because some of these guys are willing to go for grade if the place already has a mining history. They just want to know that they can work on it. And now junior companies are asked to present a little bit more de-risking than they would normally. And we've had this issue just recently. So you might be drilling an inferred resource, but they might want to know about the metallurgy now. They might want some geotech now. They might want a hydrology hold. Because the big companies want to eliminate that risk before they put in that $5 to $10 million. Okay, that's it for me. Moving on.